What if I told you that everything you've been told about economic recovery is a lie? That the inflation you're experiencing right now, the rising prices at the grocery store, the mortgage rates climbing month after month, these aren't temporary glitches in an otherwise healthy system. They're stage 3 of a 5-stage collapse pattern that has repeated 3 times in modern history. 3 times central banks made the exact same decisions. 3 times governments pursued identical policies. 3 times the result was economic devastation that wiped out the middle class. And in 2026, we're about to witness it again. There's a pattern that economists don't want you to see. Between October 1973 and March 1974, oil prices quadrupled from $3 to $12 per barrel. By 1980, inflation hit 11.6%, while unemployment climbed past 10% simultaneously, something economists said was mathematically impossible. Then, in September 2008, Lehman Brothers collapsed with $613 billion in debt, triggering quantitative easing programs that injected over $4 trillion into the financial system. Now, in December 2025, we're watching those same mechanisms activate again. Inflation above 3%. Growth below 2%. The Federal Reserve trapped. This is the story of how stagflation returns, why it's worse than before, and why 2026 will be the year the pattern completes. Let's start with October 6, 1973. On that day, Egypt and Syria launched a coordinated attack on Israel during Yom Kippur, the holiest day in the Jewish calendar. The Soviet Union supplied weapons to the Arab nations. The United States backed Israel with military aid. What happened next would rewrite economic textbooks and destroy the wealth of millions. On October 16, 1973, just 10 days after the war began, the Organization of Arab Petroleum Exporting Countries made a decision that would change everything. They raised oil prices by 17% in a single announcement. They announced production cuts. They targeted the United States with a full oil embargo. The price of oil began to climb, not slowly, not gradually, exponentially. At that time, the United States imported approximately 35% of its oil from foreign sources. American cars averaged 13 miles per gallon. The entire economy ran on cheap energy: factories, transportation, heating, manufacturing. Everything. The average American had never considered that oil could become a weapon. But Arthur Burns, chairman of the Federal Reserve since 1970, understood what was coming. He had spent 3 years expanding the money supply to help President Richard Nixon win re-election. Inflation was already running at 6% annually when the oil crisis hit. What Burns didn't anticipate was how these two forces would combine. By January 1974, the price of oil had reached $11.65 per barrel, a 300% increase in just 3 months. In March 1974, OPEC officially lifted the embargo, but the damage was done. Prices stayed high. And here's what actually happened to ordinary Americans. If you filled a 20-gallon gas tank in September 1973 for $60, that same tank cost $240 by February 1974. Your purchasing power was cut by 75% in 5 months. But this was just the beginning. Arthur Burns faced an impossible choice. Inflation was accelerating toward 12.3% by 1974. But unemployment was also rising, from 4.9% in 1973 to 5.6% in 1974. Eventually reaching 9% by 1975. According to the Phillips curve, the dominant economic model of the era, this couldn't happen. Inflation and unemployment were supposed to move in opposite directions. You could have high inflation or high unemployment. Not both. Never both. Burns chose to fight unemployment. He kept the money supply expanding. He supported Nixon's wage and price controls, which attempted to freeze prices by government decree. For a brief moment in 1972, this seemed to work. Inflation held at 3.3% while the economy grew. But wage and price controls don't eliminate inflation. They simply hide it. Like compressing a spring, the pressure builds until it explodes. After the 1972 election, the controls began to fail. Oil shocks from the 1973 crisis overwhelmed them. By 1974, inflation hit 12.3%. By 1979, it reached 13.3%. During Burns's entire tenure from 1970 to 1978, the average annual inflation rate was 9%. Think about what that means. If you saved $10,000 in 1970, by 1978, its purchasing power had been cut in half. Your retirement fund, your savings account, your life's work, cut in half. The pattern was forming. Stage 1, cheap credit and money printing. Stage 2, external shock, oil crisis. Stage 3, central bank trapped between inflation and recession. Stage 4, desperate policy measures that make it worse. Stage 5, economic collapse that destroys the middle class. Now let's examine what it actually takes to stop stagflation once it starts. In October 1979, Paul Volcker became chairman of the Federal Reserve. He inherited an economy where inflation was running at 11.6% and still accelerating. Consumer confidence had collapsed. The dollar was weakening internationally. Foreign governments were losing faith in American currency. Something had to be done. Something radical. Volcker announced new measures by the Federal Open Market Committee on October 6, 1979. The Federal Reserve would abandon its policy of gradually adjusting interest rates. Instead, it would directly target the money supply, limiting how much money could circulate in the economy, regardless of the pain this caused. The immediate result was catastrophic and necessary in equal measure. The federal funds rate, the rate at which banks lend to each other overnight, had averaged 11.2% in 1979. Volcker pushed it to 20% by June 1981. 20%. The prime rate, the rate banks charge their best customers, hit 21.5% in 1981. If you wanted to buy a house, your mortgage rate was 18%. If you wanted to start a business, borrowing costs were impossible. If you were an existing business with variable rate debt, you were destroyed. The recession that followed was the worst since the Great Depression. Unemployment rose above 10% by 1982. Businesses collapsed, farms were foreclosed. The pain was distributed across every sector of the economy. But here's what's crucial. It worked. By late 1982, inflation had been broken. It fell from 13.3% in 1979 to under 4% by 1983. The decade of stagflation was over. But let's talk about who actually paid the price. If you were a small business owner in 1980 with a $100,000 loan at a variable rate, your interest payments went from $11,000 per year to $20,000 per year within 12 months. Many businesses had been operating on thin margins, relying on cheap credit to expand. Those businesses vanished. If you were a factory worker, unemployment in manufacturing exceeded 12% during the recession. 1 in 8 factory workers lost their jobs. If you were a farmer, the combination of high interest rates and falling commodity prices created a farm crisis that lasted through the mid-1980s. Between 1980 and 1985, American farmers lost $60 billion in equity. Land values collapsed. Families that had farmed for generations were wiped out. This is what it takes to correct stagflation. Not adjustments, not fine-tuning. Economic destruction on a scale that eliminates the excess from the system. The pattern completed. Stage 1. Arthur Burns expanded money supply from 1970 to 1978. Stage 2. Oil shock, 1973. Stage 3. Stagflation, 1974 to 1979. Stage 4. Volcker raises rates to 20%. Stage 5. Recession and reset. But here's where it gets even more interesting. Because in 2008, policymakers decided they would never allow Stage 5 to happen again. Let me show you why 2008 was fundamentally different from the 1970s. On September 15, 2008, Lehman Brothers filed for bankruptcy. Assets, $639 billion. Liabilities, $613 billion. It was the largest bankruptcy in United States history. The entire financial system seized. Banks stopped lending to each other because no one knew who would collapse next. The stock market was in free fall. Within 48 hours, policymakers faced a choice: allow the recession to purge the system like Volcker did in 1980, or intervene on a scale never before attempted. They chose intervention. On October 3, 2008, Congress passed the Emergency Economic Stabilization Act, authorizing $700 billion for the Troubled Asset Relief Program. The Federal Reserve began a program called quantitative easing, a technical term for creating money to buy government bonds and mortgage-backed securities. In November 2008, the Fed announced it would purchase $600 billion in securities. By June 2010, this first round of quantitative easing had expanded the Fed's balance sheet to $2.3 trillion. But they didn't stop. In November 2010, the Fed announced QE2, another $600 billion over 8 months. In September 2012, QE3, $40 billion per month in ongoing purchases. By the time quantitative easing ended, the Federal Reserve's balance sheet had expanded from less than $900 billion before the crisis to approximately $4.5 trillion. The Fed created $3.6 trillion out of thin air and used it to buy Treasury securities and mortgage-backed securities. Here's what policymakers told you: quantitative easing saved the economy. Here's what they didn't tell you: it guaranteed future stagflation. Think about what actually happened. The Fed created $3.6 trillion. That money went primarily to banks and large financial institutions. Those institutions used it to buy assets, stocks, bonds, real estate. Asset prices soared. If you owned assets, you became wealthier. If you didn't, you were left behind. Between 2009 and 2020, the S&P 500 rose 400%. Housing prices in major cities doubled or tripled. But wages for the median American worker grew only 34% over the same period. The wealth gap exploded. This is the inflation they created, not in consumer prices, but in assets. For 10 years, this seemed sustainable. Asset inflation stayed contained in financial markets. Consumer price inflation remained low. Central banks congratulated themselves. But inflation is not a light switch. It's a slow-moving virus that takes years to fully infect the system. The $3.6 trillion the Fed created didn't disappear. It's still out there, circulating through the economy. And when the next crisis hit in 2020, they added more. Another $3 trillion in fiscal stimulus, another expansion of the Fed's balance sheet. By 2022, consumer price inflation finally emerged, reaching 9% annually, the highest since 1981. The pattern was repeating. Stage 1. Massive money creation 2008 to 2020. Stage 2. External shocks, COVID, supply chains, energy prices. Stage 3. Inflation returns while growth slows. We're in Stage 3 right now, and Stages 4 and 5 are coming. Which brings us to now, December 2025. The United States economy is entering a period economists are calling stagflation light. That's a polite term for the early stages of what happened in the 1970s. GDP growth is running below 2%, below the historical trend. Some forecasters predict growth as low as 1.1% in the second half of 2025 and into 2026. At the same time, core inflation remains stubbornly above 3%. The Federal Reserve's target is 2%. They're missing their target by 50% while the economy slows. This is stagflation. Not the catastrophic version of 1974. Not yet. But the pattern is forming. Growth slowing, inflation elevated, the Fed trapped between two disasters. If they raise interest rates to fight inflation, they crash the economy. If they cut rates to support growth, inflation accelerates. There is no good option. This is exactly where Arthur Burns was in 1973. The causes are different, but the mechanism is identical. Instead of OPEC oil embargoes, we have trade policy and tariffs raising costs. Instead of wage and price controls, we have immigration policy restricting labor supply. The result is the same: rising costs meeting slowing growth. Analysts at RBC Economics forecast that core inflation will remain above 3% for most of 2026. Morgan Stanley predicts inflation could peak at 3.5%. Some forecasts suggest growth as low as 0.8% in Europe, with similar pressures in the United States. But here's where 2026 becomes exponentially more dangerous than 1974. When Paul Volcker raised interest rates to 20% in 1980, U.S. government debt was approximately $900 billion. Today, U.S. government debt exceeds $34 trillion. In 1980, the debt-to-GDP ratio was about 35%. Today, it's approaching 125%. Think about what that means. If the Federal Reserve tried the Volcker solution today, raising interest rates to 15 or 20% to break inflation, the interest payments on $34 trillion of debt would become the largest item in the federal budget. At 20% interest, annual debt service would be $6.8 trillion. The entire federal budget is currently $6.2 trillion. It's mathematically impossible. The government would default. The dollar would collapse. The entire financial system would implode. This is the trap. In 1980, Volcker could raise rates because the government could afford the higher borrowing costs. In 2026, the Fed cannot raise rates significantly without triggering sovereign debt crisis. But they also cannot lower rates without accelerating inflation. They're trapped. And when central banks are trapped, economic disasters follow. The pattern is accelerating toward completion. We're in Stage 3, central bank paralysis. Stage 4 is coming, desperate policy measures that worsen the crisis. Stage 5 is inevitable, the collapse that resets the system. Let me show you exactly how this works, step by step, so you understand why 2026 is different. This isn't speculation. This is mathematics. Stage 1. Monetary expansion. Central banks expand the money supply to stimulate growth. This creates cheap credit. Businesses borrow, consumers spend, asset prices rise. For several years, this appears successful. GDP grows, unemployment falls. But the money created doesn't disappear. It accumulates in the financial system. In the 1970s, Arthur Burns expanded money supply by an average of 9% annually from 1970 to 1978. In the 2008-2020 period, the Fed's balance sheet went from $900 billion to $4.5 trillion, a 400% expansion. An external event disrupts the economy. In 1973, it was the oil embargo. Prices quadrupled from $3 to $12 per barrel in 3 months. In 2008, it was the housing bubble collapse and Lehman Brothers bankruptcy. In 2020, it was COVID and supply chain disruptions. The shock causes prices to spike in critical sectors: energy, food, housing, transportation. This is where stagflation begins. The external shock causes prices to rise rapidly. This is inflation. But simultaneously, higher costs force businesses to cut production and lay off workers. This is economic stagnation and rising unemployment. According to traditional economic theory, this shouldn't happen. The Phillips curve suggests inflation and unemployment move in opposite directions. But theory breaks when you combine massive prior money creation, Stage 1, with a major supply shock, Stage 2. Here's the mechanism. The money created in Stage 1 is already in the system, pushing up asset prices and eventually consumer prices. The shock in Stage 2 reduces supply of critical goods, oil, semiconductors, labor. When expanding money meets contracting supply, prices explode. But businesses can't pass all costs to consumers because incomes aren't rising fast enough. So they cut production instead. Less production means fewer jobs, higher unemployment, stagnation, and inflation, simultaneously. The central bank faces the impossible choice. Fight inflation by raising rates? That crashes the economy into severe recession. Support growth by cutting rates? Inflation accelerates. In 1974, Arthur Burns tried to split the difference, supporting wage and price controls while moderately tightening money supply. It failed. Inflation reached 12.3% while unemployment hit 9%. In 2025-2026, the Federal Reserve is attempting the same compromise, keeping rates moderately high, around 4.5%, while hoping inflation falls on its own. It won't work. Eventually, something breaks. Either the central bank accepts deep recession to kill inflation, Volcker, 1980 to 1982, or the currency collapses under sustained inflation, Weimar Germany, 1923, Zimbabwe, 2008, Argentina, repeatedly. There is no third option, no soft landing, no gradual adjustment. The imbalances created in stages 1 through 4 are too large. The system must reset violently. Now here's why 2026 is different from every previous stagflation episode. The debt level means Stage 5 will be more catastrophic than anything we've seen. In 1980, when Volcker chose recession, government debt was manageable. The recession hurt, but it didn't threaten sovereign solvency. In 2026, debt exceeds 125% of GDP. If the Fed raises rates high enough to break inflation, say 12 to 15%, the interest expense would consume the entire federal budget plus. But if they don't raise rates, inflation becomes embedded in expectations. Workers demand higher wages, businesses raise prices. A wage-price spiral begins, exactly what happened from 1974 to 1979. Once inflation expectations become embedded, breaking them requires even higher interest rates later. The longer you wait, the worse the eventual correction becomes. This is the perfect storm. 1970s-style inflation meets 2008-style debt levels meets 2026-style political paralysis. No solution works without catastrophic pain, and every month policymakers delay the inevitable, the ultimate cost rises. Based on historical precedent and current economic indicators, here's what the next 18 months likely hold. Between January and June 2026, inflation remains sticky above 3%, despite the Federal Reserve's hopes for disinflation. GDP growth continues to slow. RBC Economics forecasts growth remaining below the 2% trend throughout 2026. European growth may be even weaker at 0.8%. Unemployment begins ticking upward gradually, from current levels around 4% toward 5% by mid-2026. During this phase, policymakers will maintain that the situation is temporary. They'll point to base effects, one-time factors, transitory pressures. The media will debate whether we're in a recession. Technical definitions will be argued. But ordinary people will know the truth because they're living it. Real wages adjusted for inflation, will be declining. What cost $100 in 2024 will cost $106 in mid-2026. But average wages will have grown only 3%. Your purchasing power drops. Between July and December 2026, the pattern becomes undeniable. Core inflation remains at or above 3.5% despite a slowing economy. This is the definition of stagflation. Unemployment reaches 5.5 to 6%. Business sentiment deteriorates further. Consumer confidence falls. Credit markets begin showing strain. Corporate defaults increase. Commercial real estate continues weakening. Regional banks face renewed pressure. The Federal Reserve faces its moment of truth. By September or October 2026, almost exactly 47 years after Volcker's announcement in October 1979, the Fed must choose. Either they accept persistent inflation above 3% and abandon their 2% target, or they raise interest rates aggressively into a slowing economy, triggering severe recession. History suggests they'll try a third option: modest rate increases, 25 to 50 basis points, while hoping for the best. This won't work. It didn't work for Arthur Burns in 1974-1978. It won't work now. If inflation remains above 3% through 2026 and into 2027, inflationary expectations become embedded. Workers demand 5 to 6% wage increases. Businesses raise prices 5 to 6%. The spiral begins. At this point, the Fed has lost control. They must either accept persistent 4 to 5% inflation permanently, effectively abandoning price stability, or they must induce a severe recession with interest rates potentially reaching 8 to 10% or higher. Based on the pattern, Stage 5 likely begins between Q2 2027 and Q1 2028, either recession or currency crisis. If the Fed chooses recession, the Volcker path, unemployment could reach 8 to 10%, matching the early 1980s. If they choose to maintain lower rates and accept inflation, the Burns path, the dollar weakens significantly, inflation accelerates toward 7 to 8%, and the crisis becomes a currency crisis rather than a recession. Let me translate this into real life. If you're a homeowner with a fixed-rate mortgage, you're partially protected. Your housing cost is locked in. But property taxes will rise as municipalities struggle with budget deficits. If you're a renter, expect rent increases of 5 to 8% annually through 2027. If you're a saver with money in bank accounts or bonds, inflation above 3% means your real wealth is declining, even if nominal balances rise. If you're employed, wage growth will lag inflation. You'll feel poorer even if you get a raise. If you're a business owner, rising costs, labor, materials, energy, financing, will squeeze margins. Many businesses operating on tight margins will close. If you're retired on a fixed pension, inflation will erode your purchasing power by 10 to 15% over the next 3 years, unless your pension has full inflation adjustments. Most don't. If you own stocks, the market faces downward pressure from 2 directions: rising interest rates, which reduce the present value of future earnings, and declining corporate profits as margins compress. A repeat of the 1973 to 1974 bear market, which saw stocks fall 48%, is possible. If you own gold or other hard assets, these typically perform well during stagflation, as people seek inflation hedges. Here's why policymakers won't solve this until it's too late. The solutions required are politically impossible. To truly stop stagflation requires a Volcker-style shock. Interest rates must rise high enough to cause significant economic pain. Unemployment must rise to 7 to 8% or higher. Businesses must fail. Asset prices must fall. This purges the excesses from the system and resets inflationary expectations. But no politician will support this. No president wants a recession on their watch. No Congress wants unemployment above 7% during an election year. The political pressure on the Federal Reserve will be enormous. We've already seen this. In 2025, there were calls for the Fed to cut rates faster to support growth, despite inflation remaining above target. This is exactly what happened with Arthur Burns. Political pressure from the Nixon administration contributed to Burns's unwillingness to tighten aggressively. The result was a decade of stagflation. Even if politicians wanted to do the right thing, the debt prevents it. The United States government owes $34 trillion. At current interest rates around 4.5%, annual interest expense is approximately $1.5 trillion, already the fastest-growing component of the federal budget. If rates rose to 10%, still far below Volcker's 20%, Interest expense would be $3.4 trillion annually, consuming more than half of all federal revenue. This would force massive cuts to Social Security, Medicare, defense, and all discretionary spending. Or it would force the government to dramatically increase taxes. Or it would force the Federal Reserve to buy government bonds to keep rates artificially low, which is money printing that accelerates inflation. Every option is politically toxic, so they'll delay. They'll hope something changes. They'll try modest adjustments, and the crisis will worsen. There's one more factor that makes 2026 worse than 1974 or 2008. The entire global economy is synchronized. In the 1970s, stagflation was primarily a US and UK phenomenon. Other countries had problems, but not all at once. In 2026, major economies worldwide face similar pressures. Europe is growing at 0.8%, with inflation still elevated. China faces deflation and a property crisis. Japan has record debt levels. When the US enters crisis, it will pull the rest of the world with it. This means there's no external rescue. In 2008, China launched a massive stimulus that helped stabilize global demand. That's not coming this time. In 1974, the U.S. could eventually recover as oil prices stabilized and Volcker imposed discipline. But if the 2026-2027 crisis is global, the recovery will be slower and more painful. Trade will contract. Supply chains will face renewed disruptions. Capital will flee emerging markets seeking safety, causing crises there. The contagion will spread. The pattern is absolute. Stage 1. Monetary expansion, 2008 to 2020. Stage 2. External shocks, 2020 to 2025. Stage 3. Stagflation, 2025 to 2026. Stage 4. Policy paralysis and failed interventions, 2026 to 2027. Stage 5. Collapse and reset, 2027 to 2028. 3 times in history this pattern has played out. 3 times the warnings were ignored. 3 times ordinary people paid the price for central bank mistakes. What cost you $100 in 2024 will cost $110 in 2026 and $118 in 2027 if inflation runs at 3.5% annually. Your wages won't keep pace. Your savings will lose value. Your retirement will be delayed. This is not fear-mongering. This is mathematics. The debt is real. The inflation is real. The slowing growth is real. And the Federal Reserve is trapped between 2 disasters with no good options remaining. In 1973, oil prices quadrupled in 3 months, and stagflation destroyed the middle class for a decade. In 2008, Lehman Brothers collapsed, and policymakers printed $3.6 trillion to prevent the pain, guaranteeing it would return worse later. In 2026, those 2 crises converge into a perfect storm. The inflation of the 1970s meets the debt of 2008, meets the political paralysis of 2025. And when this pattern completes, the economic landscape will be fundamentally different. His is not about pessimism. This is about pattern recognition. If this changed your perspective on what's actually happening beneath the surface of economic headlines, subscribe. Because when Stage 5 arrives in 2027, you'll want to understand why everyone else is shocked, but you saw it coming months in advance.